14 months ago, the United States imposed the largest tariff package in modern history. Prices went up, people adjusted, and most people assumed that was the full story. It wasn't. The tariffs were wave one. What is arriving right now, hitting grocery bills, car payments, mortgage rates, and savings accounts in ways that look completely unrelated to trade policy. Those are waves 2 through 5. They were always coming. They just took time to travel. By the end of this video, you will understand exactly what each of those 4 waves is, why your brain is wired to miss every single one of them, and the one move that positions you ahead of all of them before the next wave lands. If you've been watching prices over the last 6 months and thinking something still feels off, like things should have stabilized by now, but they haven't, you are not imagining it. The story you were given went like this. Tariffs raise the price of imported goods, companies and consumers share the cost, and then the system finds a new equilibrium. That sounds like a complete explanation. It is actually just the first chapter, because prices are not only rising on the specific goods that got tariffed, they are rising in categories that had nothing to do with the tariff list. They are rising faster than the tariff rate alone explains. And in some categories, particularly food, they are accelerating right now, more than a year after the original announcement. That gap between the explanation you received and what you are actually feeling at the register, that gap is real, and it is real because the explanation stopped at wave 1. There is a quiet thing a lot of people are carrying right now. It sounds like this: we were told prices would stabilize. I am still waiting. You were told something true that happened to be incomplete. Prices from the tariff shock did partially stabilize, but the subsequent waves were already in motion, on their own slower timelines, building on the original impact rather than replacing it. Here is the reframe. Tariffs are not a cost. Tariffs are a trigger. The price change you saw on your receipt in the months after the announcement, that was the surface. What tariffs actually do, structurally, is initiate a sequence, a chain reaction that moves through currency markets, supply chains, agricultural systems, and credit markets in 4 distinct waves. Each one has a different source, a different timeline, and a different impact on your wallet. Most people adjusted for wave 1 and assumed that was the adjustment. The other 4 waves do not announce themselves. They show up as general cost of living pressure that feels like it should have eased by now. It hasn't, because 4 more things are still in motion. Wave 2 is currency devaluation. When the United States raises tariffs, trading partners respond with retaliatory measures. That creates uncertainty in global trade flows. When global trade flows are uncertain, international investors reduce their exposure to dollar-denominated assets. When dollar demand falls, the dollar weakens. A weaker dollar means every import costs more, not just the tariffed categories, because you are buying foreign-made products with a currency that buys less than it did. The Peterson Institute for International Economics estimated the dollar weakened by approximately 8 to 10% in the 12 months following the major tariff escalations. That devaluation layers on top of every import price: electronics, appliances, clothing, pharmaceutical ingredients. 8 to 10% added on top of whatever the tariff itself cost. Wave 3 is supply chain repricing. Companies do not absorb cost increases. They pass them through, but they do not pass them through at exactly the tariff rate. They pass them through at the tariff rate, plus margin protection. Every business that touches the product on its way to your store adds a buffer. The National Bureau of Economic Research analyzed the tariff cycle from 2018 to 2020 and found the consumer price pass-through rate averaged approximately 115% of the tariff cost. A 15% tariff produced roughly a 17 to 18% price increase at the consumer level. Companies used industry-wide cost pressure as a coordinated, if unspoken, opportunity to protect margins. That pattern is playing out again, and this time the tariff base is significantly larger. But that was just the 3rd wave. The 4th one is where most people get blindsided. Wave 4 is agricultural reversal. This is the one that catches people most off guard, because the logic runs backward from what you expect. When the United States imposes tariffs, trading partners retaliate by targeting American agricultural exports, soybeans, pork, corn, wheat. American farmers, cut off from their export revenue, sell domestically at lower prices to clear inventory. In the short term, that looks like relief, cheaper food, but it destabilizes the farming sector. Farms dependent on export revenue reduce planted acreage the following season. When supply tightens, domestic food prices reverse, often sharply. The 2018 to 2020 tariff cycle produced exactly this pattern. Domestic food prices, in several categories, fell initially, then rose above their pre-tariff baseline within 12 to 18 months. The timeline for the current cycle puts that reversal arriving through the middle of 2026. You are in that window right now. Wave 5 is credit ceiling. Tariff-driven inflation is what economists call cost-push inflation. Prices rise because production costs rise, not because consumers are spending more. The Federal Reserve's primary tool against inflation is raising interest rates, but raising rates into cost-push inflation does not reduce the underlying cost pressure. It just makes borrowing more expensive on top of it. The Fed is navigating what its own meeting notes have described as a difficult dual-mandate environment. Inflation still above target, growth slowing, no clean policy path forward. What that means for your wallet: mortgage rates staying elevated, car loan rates staying elevated, credit card rates staying elevated, not because the economy is overheating, because the trade environment has created an inflation dynamic the Fed cannot fix with rate cuts without risking further dollar weakness and more inflation. Here is the part that explains why most people are managing this wrong. Princeton's behavioral economics lab published research in 2014 on what they called complexity-induced inattention. When a problem appears to have one clear, visible cause, the brain stops looking for others, not from laziness, from efficiency. The brain assigns the explanation, marks the category as solved, and redirects processing power to something else. The tariff was visible, named, in the news every day. Wave 1 arrived, and the brain filed it. The 4 subsequent waves, operating on slower timelines, through less visible mechanisms, moved forward without a mental category to land in. They show up as background pressure, a vague sense that the math still does not quite add up. It won't until you account for all 5. Here is the one move that changes your position before the remaining waves land. In the next 48 hours, look at your 3 largest monthly expense categories and identify which ones are exposed to import pricing, food commodity cycles, or borrowing costs. Those are the 3 channels the remaining waves move through. For any exposed category where you have the option to lock in a rate, a price, or a contract, do it now. Insurance renewals, service contracts on appliances, subscriptions tied to physical goods. Every locked-in cost is a direct hedge against price waves that are still accelerating. You do not need to predict the Federal Reserve. You do not need to track the dollar. You need one 48-hour audit of your 3 biggest expense lines. Most people will not take that step, not because they do not care, but because tomorrow there will be a new headline and the brain will have already moved on. The window does not close with the headline. It closes with the next price increase. You watched this to the end. You have already done the thinking. Most people will skip entirely. If this changed how you see the next 6 months, drop a comment. Which of the 5 waves concerns you most? And if you have not subscribed yet, the next video in this series covers what the credit ceiling means for anyone within 10 years of retirement. It is the most undercovered part of this story. The tariffs already happened. The question is whether the 4 things they triggered have been priced into your decisions. Yet, that part is still up to you.